Hello guys, welcome to a new video and I hope that you all are doing well. Today I wanted to discuss a new charge that I have been seeing in Robinhood account for a last couple of weeks, and when I dig further into that I saw where it is coming from, and I have some ideas on how you can kind of mitigate those charges. So that's what we are going to discuss in today's video. So stick around and we are going to discuss all about that. So recently I opened this trade in AMD, as you can see here. This was a call credit spread that I opened with 112 and 113 dollar. And when I looked at the trade, it looked fine to me that I'm getting a kind of a credit overall of $30, as you can see here. But when I looked deeply in the order book, I saw some new changes, right? As you can see here, when I looked at this trade, this complete trade, it may look like a broken down on certain like a different trade. So you can ignore that part, just focus on this particular part, right? These charges have increased, and you maybe sometime they are showing it on the screen that I showed before here when you open the trade, but sometime they don't show it here. So when you download these charges to your local computer, right, it kind of downloads as a PDF, and when you look at that PDF you will see these kind of charges here, and they have increased from last couple of weeks. So when I dig further into that, what I found out was if you look at their fees, right, there is a new fee that has been added. If you look at here, right, on September 21st, and that's why I said like from last couple of weeks I have been seeing this transaction fee. So they have added a combined fee of 3 cents, right, and this is for each leg. So if you open like if you open a spread in options, right, which is a combination of two legs, so that means you're gonna pay 6 cents per trade, right? And if you open multiple contracts, so that kind of multiplies, right? Like if I take an example, right, if you open, let's say you open two spreads, right, uh, and then per spread, as I said, right, per spread is two contracts, so that is like a 6 cents each, and then that will combine into like a 6 and multiplied by 2, right? So that's like a 6 cents, and then if you open two contracts, so that's gonna be like a total of 12 cents that you have to pay for that particular contract. And as you increase your number of contracts, this is gonna further increase, so this is gonna eat up into your profit, right? Although you cannot avoid it completely, there is one way that I can say that you can kind of mitigate it somewhat. I'm going to explain that with one example. So let's look at how you can actually kind of mitigate to some point. You cannot avoid it completely, as I said. So let's look at one example, right? So I'm going to take again example of AMD. So let's say you opening a spread trade, right, in AMD. So if you go to, like, let's say we are opening a call credit spread, right, which is kind of a two legs. So if you go to, let's say, a month out from now, and then you open let's say you think that AMD is not gonna cross 110, you open like this credit spread, right, which is built of like 110 and 100. It's $100 spread. Now if you see, right, it shows 30 here, but as I show, right, sometimes they display it here, but sometimes they don't display it here. So just you have to be careful about that. So if you just open one contract, that's fine, it kind of you can ignore that, but the problem comes when you open like multiple contracts here, right? If you open 5 contracts, then it's gonna kind of it will be eating up from your total credit that you're gonna receive, right? It will still be percentage wise pretty small. So this is something that they did not have before, but now they have started charging this, right? So we have to be careful about that. So the way that I was going to show, right, so instead of let's say if opening it like 5 contract, right, what you can do is you open one contract, but you reduce or move your strike prices down so that you're going to get the same kind of credit. So let's say you are opening 110, right? So instead of opening 110, you start from 109 or 108. So that's gonna kind of you will have to open less contract, but you're gonna still get the same kind of credit. Okay, so that's one way to avoid it. Again, as I said initially, it cannot be avoided completely, but the way that you can kind of get the same kind of credit what you get from multiple contract is going closer to the money. That has its trade-off. You are increasing your delta, right? So as you go closer to the money, your delta is gonna increase here, right? So there's a higher chance that it goes in the money, but that's a trade-off you can make based on your analysis of the support, or where you see that the resist in case of call credit spread, right? That's the resistance that you should be careful about, that where is the resistance that you see for AMD, for example, right? So that's one way. It's like to sum it up, I would say you down your strike price by one. That's gonna kind of compensate towards your multiple contracts, right? So instead of two contracts, you downgrade one strike price, and that's gonna give you slightly more credit as well, and you will be paying less in your this new transaction or regulatory fee that they have started charging now. Okay guys, so that was the video for today. I just wanted to quickly discuss what I observed, and if you want to know more about all these trading ideas or the spreads, that I am creating a new Robinhood series where I am putting like within 5 minutes I'm trying to explain all these strategies in a very quick manner. I have other multiple videos where you can go and see in detail if you are interested in learning about these spreads and different option strategies. Okay guys, so that was it for this video. If you like the video, then please consider subscribing, and I'll talk to you in my next video. Happy investing guys. Bye bye.